All right, good morning, everybody. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland. And I would like to thank everybody for joining us today for the workshop today. And I especially would like to thank Joe Ward, Principal at Miles and Stockbridge, for leading the workshop today. So Joe's corporate transactional practice includes domestic and cross-border mergers and acquisitions, reorganizations, leveraged buyouts, spin-offs, joint ventures, and the drafting and negotiation of commercial agreements. Joe also regularly represents companies, owners, management teams, sponsors, and investors in connection with private capital market transactions, such as venture capital and other private debt and equity investments, private offerings of securities, and the formation of private investment funds. In addition, Joe provides general corporate advice to both private and public companies regarding corporate governance, securities, compliance, Maryland corporate law, and other general business matters. In other words, you will enjoy this workshop. Joe is very experienced, and I think you will learn a lot. Before we begin, just a few announcements. If you have any questions, submit them via the Q&A function at the bottom of your screen. And we will monitor them. Either Joe will see them or Wendy will see them, and Joe will answer the questions as they come. At the end, you will be also able to raise your hand and unmute your mic and ask your question live as well. We are recording this workshop. It will be posted, and you will be able to watch it again if you think that you missed something. So without further ado, thank you, Joe.
Well, thank you very much, Ala, for that nice introduction. Good morning, everyone. Appreciate the nice intro you gave to me, Ala, there. All that stuff sounds way more, probably sounds way more complicated or extravagant than it really is. But happy to be here, happy to put on this, this little workshop for folks. Ala and I were speaking, and I've done this workshop before because we find in our practice that lots of founders are busy scrambling around, running around, starting their companies. Many of them have not done this before, and they go to look for money, and there is, they fall into a massive confusion around the different financing terms, the different financing vehicles that are used in the startup world, and how to navigate through that. So we thought it would be good to give this presentation to help founders understand and at least give them a baseline of some different mechanisms that we use in the venture capital world to finance startup entities, and then to give you guys some tips on things to look out for, what are some of the most important things to focus on, what are other things that are maybe a little less important or where there's more flexibility, and just generally to sensitize everybody to the issues that they'll come across when they're looking to negotiate term sheets. So we'll begin with various types of investment options that ordinarily present themselves in the startup world, and there are 5 key types of financing mechanisms that are used. If you were to Google startup or venture early stage financing, any of those terms, you'd see a bunch of articles and a bunch of material on all of these, and it can be very overwhelming to various people. So I'll lay them all out, but then we'll talk about 2 most specifically. But there is a financing mechanism called a SAFE, or a simple agreement for future equity, that exists. This is something of a newer type of financing mechanism. I think, frankly, the jury is still a bit out on how effective this financing mechanism really is. I would say it is used much more on the West Coast than it is on the East Coast, although it is used here. I have used it any number of times. It has benefits and detriments on both sides, both to the company and to the investor. So generally, I would categorize it, in my experience, as being something more favorable to the company and less favorable to the investor. But it is effectively a document where an investor would give capital to the company with an agreement that the company will give them equity at a future time based on a future valuation and based on a number of other events occurring. And that's effectively what that agreement is. It looks very much like or it's similar in respects to convertible promissory notes that we'll talk about in a second. The reason that it was created was that convertible promissory notes are in fact debt of the company and have to be carried on the company's books as debt. Some companies didn't like to raise capital in that way where they had debt on their books, and so someone very smart came up with this safe, which has many of the same features of a convertible promissory note, except it's not indebtedness, so you don't have to record it as debt on the books. I think that's a little bit of an open issue because if you're an accountant looking at it, I'm not sure you would say that it's not some kind of a contingent liability that should be booked anyway. But that's the genesis of it. So there are these agreements called safes. There are agreements next called a KISS, which is basically similar to a safe, but a lot more pared down. I frankly don't see these used hardly ever. So they do exist out there, but they're not a very common type of financing mechanism. The next is convertible promissory notes. This is the tried and true early stage financing mechanism that folks have used for decades. So the idea is that if a company is at an early stage and you don't want to engage in conversations around company valuation, you don't want to give up too much of your company at an early stage, or you're just not prepared to have the discussion about how much you would be willing to give up, you can take in the investment through a convertible promissory note. So that is a debt. It's a promissory note that by its terms is supposed to be repaid, usually within about a 24-month period, sometimes 36, but most often it's a 24-month period. It earns an interest rate. Typically that's 8%, but it can vary anywhere between, call it 6 and 10%. And it will, the key feature is that it will convert into equity in the business at a later time when you actually go to do an actual equity round. That lets you push the valuation conversation down the road quite a bit, lets you get further in development of the product. And so the company is in a better position to have valuation discussions, hopefully to give away less than they would at a very early stage. And so those convertible promissory notes have been used, like I said, forever. Very common, and maybe that's still the most common instrument that folks would use at the earliest stage. So we're talking about friends, family, sometimes angels, but even sometimes it's earlier than angels would even invest, although many angels will still invest in convertible promissory note rounds. So moving on, the next is what's called a Series Seed preferred stock round. So many people maybe have heard of the last thing we'll talk about, which is a Series A preferred stock. So that's kind of, it used to be your very first equity raise was called Series A. And then we found a bit of a gap that existed in the financing structure between companies who could only really raise money at the convertible promissory note stage, and then investors who were willing to invest in a Series A round wanted much higher dollars going into companies with much more in terms of revenue and customer adoption. And so there tended to become this gap in between, and these companies found themselves in a spot where they were they didn't want to keep doing promissory note rounds, but they weren't ready to do a Series A round. And so a market developed for what they call the Series Seed round, which is really just a Series A preferred stock round that's tailored down. So some documents have been eliminated. Some of the terms and conditions you would ordinarily see in a preferred stock round are lessened more to the favor of the company. It's a Series A light type of a financing structure. And then you get into the Series A preferred stock. That's the traditional, what most folks know of as your first significant capital raise or equity round, where you are selling us a material portion, a significant at least portion of the stock of the business, selling them to outside investors. Hopefully at that stage we were talking about institutional and venture capital type investors. And there's a bunch of terms and conditions that are going to go along with that we'll talk about. So these are the 5 core things that most anyone would see if they started to look up early stage company financing. And for the purposes of this presentation today, we're going to focus on convertible promissory notes and Series A preferred stock rounds, because those are the 2 most common that folks encounter. So when you're talking about any term sheet or any investment, the absolute most important points, at least from my perspective, are these 5. So valuation is always number 1. What is your company valued at? And what that really means is how much are you willing to give away to an investor for how many dollars? So in an equity round, in a Series A round, you have to determine that Series A round determines valuation. Valuation is the number 1 topic of conversation. Your Series A round sets a valuation and says how much you're willing to give away at that moment, but it also sets a valuation going into the future, so that if you have to raise more capital down the road, you need that valuation to be set at a number where you are hopeful that the valuation will grow. There are situations in which the valuation can decline, and you have to raise additional capital at a valuation that is less than your previous capital raise valuation. That's what we call a down round, and that has all kinds of different negative implications in the documents, aside from just the maybe psychological or emotional feeling of, well, the company has actually gone down in value. The various investment documents can have ramifications in terms of giving your investors then a greater piece of the pie in that down round. So while this is certainly a topic of discussion in every equity raise, even if you're doing a convertible note round, the valuation discussion will occur. And as you'll see, and when we go through a model term sheet, you'll see that valuation does come up. It's still a significant discussion point in convertible debt rounds, but I would say that it is a much more relaxed discussion in a convertible note round, because while you are discussing valuation, you're really punting it to a later time. Your investors are going to set some parameters around what that valuation might be at a later time. But it's a much more relaxed discussion for convertible notes than it is when you're actually issuing equity, and it is the most relevant factor in that equity raise. I think the next most relevant factor is corporate governance. So if you're selling equity, you're selling a piece of your business, that investor is now a partner in your business, and how the company is run is front and center. There are usually many, many restrictions that those investors put in the documents in terms of how the company can be run. They will often demand board seats to sit on your board. They may want to reconstitute your board fully. There will be special approval rights and voting rights that they will demand. And so corporate governance, when you're selling equity, is a point of much negotiation. In convertible note rounds, there's usually very little and sometimes no corporate governance discussion. These investors are debt holders. They're creditors of the business, and that's all that they are. We sometimes see convertible note rounds where there will be a restrictive covenant put into the document. So as an example, they would say, you have to get the approval of a majority of the holders of the convertible notes if you are going to incur any expense in excess of a certain amount of dollars. So they want to kind of control how the dollars are spent that they're investing in you. But that only happens sometimes and very often not at all. So corporate governance in many convertible note rounds is not even a topic of discussion, but it can creep in. The next big point is conversion. And this is the whole point of a convertible note round for sure, is that those notes and the principal balance and the interest convert into shares of equity in the business. So how that conversion happens, when it happens, is it an option for it to happen, or is it mandatory? There's any number of issues around conversion that are front and center that you'll see. And in a corresponding way, even if you did a Series A round and you issued preferred equity, that preferred equity can convert into common stock or common equity. And the way in which it converts into common stock and how many shares of common stock per one preferred share of stock is also a big issue of discussion. So the way that these instruments convert from one thing to another is a big point. I see there's a Q&A, so I'll go ahead and jump in and try to answer that live so that we can stay on. It says, what is your perspective on the form of funding available through Start Engine? How does it play out with the traditional schemes of financing that you have just covered? So actually, I'm not actually that familiar with Start Engine. So I'm not sure that I can speak to what their platform is. I know there's a number of competitors out there. I say competitors meaning this. The Series A financing documents used to be drafted by lawyers. Every law firm had their own suite of Series A documents. Everyone had their own take on it, and you would have to review a different set of documents every time you did it. There's a group called the National Venture Capital Association that came out with it's a trade association that came out with a set of model documents. And frankly, those model documents they really have taken off. And now many times all of us practitioners use them as the basis for the Series A documents. Now we all have our own modifications that we like to make to them. We all have our own language that we think is an improvement or modifies an issue in some way. But that suite of documents has really come out and been used a lot. When you're talking about the SAFE, the Simple Agreement for Future Equity, another organization called Y Combinator actually came up and developed that document. And now many people will use that form of their document. And I know that there are other competitors out there, meaning there are other groups that are advancing, suites of documents or financing models that are a little bit different from this. So I'm familiar with some. I'm not familiar with Start Engine and what particularly they do. I'll have to look into that and maybe cycle back to you guys afterwards with some thoughts on that. So going back into the major points, the future investor rights is always something of an issue. So in an equity round, those investors are going to ask for rights into the future, meaning when you go do another round of financing, they're usually going to want to be able to participate in that round. There's also items that they will cover. So if it's a venture capital fund, they're going to want to be able to seek liquidity of their investment at some point. So they're either going to want to be able to sell the company or try to force a sale of the company or cause the company to go public so that they can sell their shares after an IPO. There's a number of rights that they will be asking for. This issue again is less so with a convertible note round. Usually in a convertible note round, at most you would see those investors asking for rights to participate in the Series A round. But there's usually not much in terms of future rights that are given to investors in a convertible note round. And then the last point is the founder rights. So the founders of the business, not only are they going to be giving up a portion of the company if they do an equity round, but Sometimes your equity investors will ask for other things. So they will ask for the founders to restrict their ability to transfer or sell or even gift their stock in the company. Sometimes they'll ask the founders to actually have their ownership be subject to some sort of a vesting schedule. So even though you may be the founder of business, you came up with the idea, you've been, bootstrapping the company yourself, and this is your baby. Some investors may ask you to put a vesting schedule on your ownership so that if things don't go well, and if you decide to leave the company, or if you would ever give them the right, if they have the right to fire you, you may have to forfeit a portion of your equity. That used to not happen very much. We're seeing that much more. Some investors believe in it very deeply. Some investors actually don't believe in it at all. So it's not in every deal, but it certainly is an issue that comes up in enough deals that that it should be it should be in your mind as something that some people may ask in the future. So coming back, okay, so just doing a very quick comparison. If you're trying to figure out in a startup, do I do a convertible note round or do I do a preferred equity round? Here's a quick side-by-side comparison for you. So when it comes to valuation, and I mentioned some of these, but when it comes to valuation, you don't have much discussion about that, if any, in a convertible note round. It's very important in a preferred equity round. Governance, there's almost no governance discussion in a convertible note round. There very much is so in an equity round. Negative controls, this is what we call approval rights or consent rights to certain transactions, hiring and firing executives, spending more than a certain amount of money. Those are rarely ever in a convertible note round, and they are often in almost in all preferred equity rounds. Any stockholder rights, that does not exist in a convertible note round because they're not stockholders. In a preferred equity round, they absolutely do exist, and we're going to show you some of them and what they might be. Conversion, how does the instrument convert and what does it convert into? Like I mentioned, conversion is a big item in either one of them, frankly. But in the convertible note round, you're converting from debt to equity, and in a preferred equity round, you're converting from preferred equity to common equity, and there's different mechanics around both of those. So at this point, and I'll just check the Q&A, looks like we're okay. At this point, we'll go into a bit of a deeper dive and walk through a couple of term sheets for you guys. And feel free to ask questions as we go. I will tell you that, we'll walk through a term sheet for a convertible notes and note round and a term sheet for a Series A round. At the end of the day, what we won't have covered, or we won't show you basic terms on, is what we call a cap table or a capitalization table. For those that aren't familiar with the term, this is your ownership table. So it's a list of all the owners and how many shares they own, and option holders, and what happens if the option holders exercise their options to buy shares. What if you've issued other types of equity? How do you manage who has what? That's all found in what we call a cap table. And the cap table is I call it the holy grail. I mean, it is what everybody owns at the end of the day. It's usually a spreadsheet with few people on it. It's very simple. I have some clients that have absolutely enormous cap tables with multiple classes of equity that can exit the business at multiple different times at different valuations. And so a cap table can become very, very, very complicated. But I would say, as a founder, as someone running a startup, I would encourage you to study what a cap table is, understand a cap table, because believe me, every investor who invests regularly knows how a cap table works really, really well. And in most of your discussions, you'll have up on your screen your cap table and what does the effect of the ownership shift or change, whether it's an equity investment or it's a convertible note converting to equity, what effect does that have on your cap table, how much the founders own, how much other key employees own, whether through options or otherwise. But it is a dynamic, living, breathing document that will live with the company. So getting up to speed on that is really critical for most founders. And some lawyers are good at it. Some lawyers like it. I like them very much. I spend lots of times in cap tables. I like math and I like the dynamics of it. Some lawyers don't feel comfortable with it at all, and they'll tell you they won't even touch your cap table. You'll have to kind of talk to a finance person in order to do that. But even if you as an owner are don't fancy yourself a finance person or particularly savvy with those types of numbers, I would still encourage you to figure it out, because like I said, it'll be a part of many of your conversations, and understanding your cap table is at the end of the day what it's all about. So I'm going to see how to, give me 1 second, and I'll pull up the first of our I'm going to pull up the first of our term sheets. Okay, here we go. All right, that is, I'm not sure if you guys can see that at the moment, actually. Let me see if I can try this.
Yeah, we can see.
Can you see the term sheet?
Yes.
Wonderful. I have to get it up myself now. Okay, great. Bear with me 1 second here. Okay. For convertible term sheets, there is no one has put out, I think, in my estimation, a really great universal form for term sheets. So most firms have developed their own. So what you're looking at here, this is our firm's form of a convertible note term sheet. I will scroll through this. I've highlighted what I think are kind of key provisions to point out to folks. And let's start here at interest rate. So as I mentioned, the convertible notes will have an interest rate. They're debt, and so like any other lender, you're expected to pay interest here, except the interest is not payable currently. It just accrues. So they charge interest on the note. It accrues, and then it's only paid when the note actually converts to equity. It does not compound usually. It's just a simple interest rate. Like I mentioned, it's typically 6 to 8%. We've seen some investors ask for 10%, but it's almost always, frankly, 8% interest. The maturity date. So when is the note due? The whole point of a convertible note is that it actually converts into equity at a certain point in time. So how much runway is the investor going to give you before they're going to call the note due? And calling the note due sounds kind of ominous, but in reality, if you're a startup, you're going to take the money in, you're going to spend the money. At the end of the day, if you get to 24 months or 36 months and the company hasn't taken off, they can call the note all they want. You're not going to have the money to pay it back. So, and the investors know that. So the whole point of this thing is to convert. Most of the times, that maturity date is 12 to 24 months. I would say 24 months is by far and away the period of time that's mostly used. Sometimes we see them at 36 months. I have done them where it's a 60-month convertible note. That's on the extreme. Like I said, most times you're going to end at 24 months. We definitely have seen 36-month notes used as well. Conversion events. So what causes a convertible promissory note to actually convert into equity? Well, the one that everybody wants, frankly, is a qualified equity financing. So that is usually a preferred. Usually it's a preferred stock financing. Sometimes people will say if you sell enough common stock, that'll trigger it. But Most of the time it's a preferred stock financing when you raise a certain amount of money in that financing. Like I said, typically it's between $1 and $3 million. I find usually many people use $2 million as the number. And so when you go to raise capital, you're raising preferred equity and you're going to sell 2 million or more of that preferred equity, then that would cause this note to convert. Okay. But there are other instances that could happen. Before you raise equity, you could sell the company. So a sale event is usually a triggering event to convert as well. Same for a merger. Of course, sometimes the note holders will say, well, if we get to maturity, if we get to that, call it 24-month period, and you have not had one of these other things happen, then I have the choice to either call the loan and you have to repay it, or I could convert. I could convert into maybe common stock at that point. And we'll talk about, there'd be some set valuation to be able to convert at that time. So some notes do that, some notes don't, highly dependent upon what the investor wants to do and whether you're willing to negotiate for that. But sometimes maturity date is also an event of conversion. So conversion price, how does this work? So if you're going to convert, and let's say you convert in a qualified financing. So you're selling preferred equity, it's more than $2 million at a later date. When you sell that equity, those investors are negotiating a per share price. And let's say that they negotiate $1 a share as the price they're buying your company or buying into your company. This, so ordinarily, the convertible promissory note would convert at $1 a share. So if the note is $100, they get 100 shares. However, convertible note investors almost always ask for a discount. This is to compensate them, in addition to the interest they're earning on the loan, this is to compensate them for taking the risk of being an early investor. It's basically a risk premium they charge. It's usually a 20% discount. So they'll say, whatever you sell your stock for in the preferred equity round, we're going to convert at that price, but at a 20% discount. So if you're selling at $1 a share in a Series A round, they're going to convert their promissory note at 80 cents a share. So they're going to get more. They're going to get more shares of stock in that equity round. And so we have a question here: how often are convertible notes actually paid off versus converting to equity? Is it possible to pay off the debt instead of converting? Outstanding question, and it might be a segue right here. Segue to another highlighted area. So almost never can you prepay the note. Most notes have a provision right here that says that you absolutely cannot prepay the note. It would be great if you could. That way the founders could pay off the debt, only have to pay the interest that accrued on it, and they can do a financing round and they don't have to share it with the convertible debt investors. Almost every promissory note, at least something that's drafted by a lawyer who knows what they're doing, is going to say you absolutely cannot prepay, because that would be, that would basically, these convertible note investors are not investing to give you, to give you debt, at an 8% interest. They want a much more upside by converting to equity. So it would undercut kind of the purpose. But that's a fantastic question, and definitely something that we've seen people try to negotiate for, but not successful. Let me go back. So we talked about conversion price. So we talked about conversion price if you actually raise equity. Let's say one of the other conversion events was to sell the company. Typically in that case, the note is not going to convert because you're selling the business. So they would be converting into a company that was being sold. What happens usually in that case is that the investors, they'll negotiate to just be paid some multiple of their investment. So, and usually that's somewhere between 1.5 and 3 times their investment. So if you do a convertible note round You're expected to go do a Series A round at some point, but you have a buyer that swoops in, offers you a great deal. You want to take it. That's fine. The convertible notes don't get in the way of that, but the convertible note holders will usually receive some multiple of their investment in that transaction. And then the conversion price, let's say another situation we talked about was what if there's no qualified equity financing? What if there's no sale event and we get to the maturity date and at that point the investor wants to convert? Usually you set a predetermined valuation amount and what we call a deemed enterprise valuation. So this is one of the few instances in which a valuation discussion does work its way into a convertible note round. If this type of conversion feature is present in your convertible note round, you will have a discussion about what the valuation of the company would be if you can't actually raise equity and you can't actually get to a sale and the investor wants to convert into the company. You're going to set right here in the convertible note round what that valuation would be. Let me scroll through here. An important point to make is, what does it convert into? What does a convertible note convert into? It converts into the class of equity that you are selling to the outside investors. So if you're selling Series A stock, it's going to convert into Series A shares. It's not converting into common stock. And those Series A shares are going to have all these different rights that are afforded to those holders, and these convertible note holders are going to get all those rights. There has been an uptick recently in what we call shadow preferred stock, where the convertible notes would not convert into Series A stock. They would convert into a class of stock that looks just like the Series A stock, except it has a couple of minor differences to it to account for the fact that the convertible note holders, when they bought a Series A share, if you were selling it at $1, they only bought it at 80 cents. And so if you were to go liquidate the company at a later point, your Series A investors are going to get $1 per share back. At least that's kind of the minimum they're going to get back. They can get back much more, but the minimum they're going to get back is $1 a share. And since the convertible note holders effectively bought the same shares at 80 cents, they shouldn't also get $1 a share back because they didn't pay $1 a share for it. So the Series shadow preferred, this shadow preferred concept is a series of stock that addresses the economic differences between the real Series A stock that you issued and the preferred stock that you should be issuing to the convertible note holders. So that's a kind of a newer thing. It's become very prevalent lately. I really like the idea of it. I think it makes a ton of sense. But sometimes, frankly, it's not even in every deal, and some people don't waste the brain power or the negotiating leverage to really fight about that issue and negotiate over it. I mentioned before preemptive rights. So usually your convertible note holders are going to want to, they are usually going to want to participate in your future financing. So that you often give them that right. I highlighted on here non-transferability of the convertible notes. So these are investors, and when you're bringing somebody to the party, you want to make sure that date stays with you. So we usually make the notes non-transferable, so your lender cannot transfer them to someone else. You want to know who your lenders are because they could convert into equity, and those are future people who are stockholders, and you want to know that's not a competitor or not somebody who you have a bad history with, or somebody who's known in the industry to not be a very good investor. So you want to make them non-transferable. So that is a quick, very quick, probably too quick snapshot of a basic term sheet for convertible note financing. And because we don't have a ton of time, I'm gonna check our Q&A here. I think we've got that. Okay, I think we're okay. And I'm gonna then stop sharing that one and jump into our next, which is a term sheet for, bear with me one second. all of a sudden can't find my other document. But I will jump in here in a second to the term sheet for a Series A preferred equity financing. So give me 1 second and I'll get that up on the screen. I believe this is it. So can you guys see that term sheet now?
No.
No, not yet. Okay. Bear with me then.
Something's happening. Now, yes.
Now, yes? Okay, great. Thank you. Thank you. Okay, so I mentioned to the group before, there's a group called the National Venture Capital Association, NVCA was what we all call them. And they have produced a suite of model documents for an entire Series A round. So all attribution to them, they have created what I view as a really good suite of documents. Many, many people use them. You can find them online. And they're free. They're downloadable. Anyone can look at them, download them. You used to have to put in your email address to download them. I think you may be able just to download them directly now. They're really very good because the NVCA is a trade association that's pulled a lot of lawyers and venture capitalists together, and they've put these term sheets together and they've annotated them. So they tell you why they have certain provisions. They even tell you, the case law around why something may be worded in one way or a different way, or which provisions may be more favorable to investors, what might be more favorable to the company. So they're really a useful tool. I wouldn't suggest, as founders, if you have counsel, I wouldn't suggest that you have to necessarily look at these. Maybe if you're having trouble falling asleep one night, they could be useful. But some of them are pretty dense. But if you do have a hankering for it, they are available. But we'll use this as a model for a typical Series A investment. And where one thing you could see out of the gate is, whereas our convertible note term sheet was 5 pages, this is 18, and probably 15 of that is real content. There are many, many, many more issues to tackle when somebody is actually buying equity. Somebody's actually buying equity in your business. Okay, so they set a number of terms. They set a number of terms here. Closing date. None of these are particularly juicy to dig into, but so I've highlighted ones that are. Pre-money valuation. So this is the valuation discussion that I mentioned. This is what what is in the forefront of everyone's mind when they enter into an equity financing. So to help with some terminology, there is a pre-money valuation and a post-money valuation. The pre-money valuation is, what is your company worth before the venture capital fund or whomever puts money in it? And the post-money valuation is the pre-money valuation plus whatever money was invested. And that's what you have immediately after. So the discussion around the pre-money valuation is key. You will always note that these discussions are held on what's called a fully diluted basis. So fully diluted means we not just want to know about the number of shares that are actually issued and in people's hands. So real shares actually issued to folks. We also want to know about all the options that are sitting out there that, if the option was exercised, could be exercised and could turn into a share of stock. We want to know about any convertible promissory notes that could be converted into stock. We want to know about any warrants that are out there. And a warrant is really just a stock option. It just has a different name and it's used in some different contexts. But any other security that's out there that could turn into a share of stock, that has to get folded into the actual total number of shares that we're looking at. And that's what's called a fully diluted basis. And that will often take into consideration a certain size of an employee pool. So if you're a founder and you've got a handful of people who are in the company right away, what they all own, you're going to go raise money. both you will probably want to set up an option pool for employees and other people that you bring in, but many times your investor will want you to bring in to stand up an option pool too, to bring in those same employees. They'll usually require you in many cases to establish an option pool. Usually it's around 10% of the total capitalization of the company. That's negotiable, certainly depending upon size of the company, what your hiring forecasts are like, whether in your specific industry, the use of stock options is really an attractive feature to acquire new talent. So there's a bunch of factors, everything's negotiable, but it's often there, and it's often about 10%. So dividends. So dividends on the preferred stock. So dividends are frankly just like interest on the convertible debt. It's a percentage, like an interest rate that accrues on the capital that's been invested in the business. So your Series A investors will want these dividends to accrue on their shares. Sometimes there's a stated dividend. Again, this is often 8%, just like the convertible notes were. I would say there's more and more of a trend these days, however, to actually go with what we call like a dividend light situation, where dividends are only accrue if, as and when the board decides to pay dividends on the common stock, which frankly doesn't really ever happen. So the dividends actually don't accrue many of the times now. But there are many, many deals that fall into this alternative too, where there is a stated dividend amount. So this interest rate that accrues on the money. And it's usually never paid until a sale event. So it's not like you have to reach into cash flow and pay it now, but it does exist sometimes. We just check. I think there's another question, a couple of questions. Let's see, other than not having a good attorney, what are the biggest mistakes that entrepreneurs make during negotiations with investors? Biggest mistake number one is giving away too much. So that's usually a symptom of not being prepared enough for the valuation discussion. So they end up, a founder is not versed well enough in a valuation discussion, doesn't know how to tackle the back and forth with the investor, and frankly gets a little taken advantage of, and so they end up giving away too much. They act too desperate, and so they give away too much of the company. That is probably by far the absolute biggest mistake. Another mistake is frankly trying to raise capital and not looking far enough ahead. So many investors don't like many founders don't like raising capital. Asking for money is not something many people like to do. They don't like the sales pitch they have to give. And so they kind of want to get in and get out, raise capital, and just get past it. And they're not thinking about what does the next capital raise look like, and how does this capital raise fit into that one? So am I agreeing to terms now that I wouldn't want to agree to later? Because once I set terms in this round, your next investor is going to come in. First thing they're going to ask you is, what did you agree to with the first guy? And you're going to have to show them. And if you agreed to terms that you wouldn't be willing to give to somebody in the future, you've put yourself at a really disadvantageous negotiating position by agreeing to them up front. So I would say the two biggest things are, giving away too much and not focusing on what the next equity round might look like, and how is that going to shape this current equity round. Another question that came up is, what are the rules of thumb for startups pursuing one means of financing versus another? In other words, for a company that hasn't raised capital, why would it favor a seed round selling equity versus a safe or promissory note round? Great question. So probably the number one driver behind that decision historically has been valuation. So companies are too early. They don't want to engage in a valuation discussion. And so whereas in an equity round, you have to engage in a valuation discussion. That is what that whole round is about. If you move to a safe or a convertible note round, while you cannot eliminate the valuation discussion completely, you can minimize it. And usually it's a much more relaxed conversation. And frankly, when it comes to valuation, everyone's kind of putting a finger up in the air and seeing which way the winds are blowing. So that is probably the number one driver. On secondary, but still a strong driver, is these equity rounds are expensive. As you can see, just a term sheet is like 3 times as long as a convertible note round term sheet. So the documentation around a Series A round is significant. The negotiations can be protracted sometimes, and it's just expensive in terms of paying your lawyer, and maybe your accountant and who other advisors you might have. They can be expensive. Convertible note rounds and safe rounds are very inexpensive. They are simple to do. They are fast to do. It's usually 1 or 2 documents that are short. And those 1 or 2 documents are shorter than any one of the 5 documents that you'd see in an equity round. And so it's shorter, faster, and cheaper to do a safe or a promissory note round. So aside from valuation, you get the quick, fast, and cheap model, and that usually drives, especially the earliest stage startups, into wanting to do a safe or a promissory note round and saving the preferred equity round to a point when they have the cash to do it. Okay. So let's go back to our term sheet. Liquidation preference. This is a big deal, and what does it mean? So when the Series A investors are investing in the company, they're getting preferred stock, and preferred means it is preferred to the common stock. And really what it means is, if the company were to sell, they're trying to set a floor of what they would get, what these investors would get in that sale, a minimum amount. And that's called their liquidation preference. And what it typically is the liquidation preference is exactly what they invested. So it's dollar for dollar what they put in the company, plus any dividends, whether they were required dividends or whether there were dividends that the board authorized and said we're going to pay on the shares but haven't been paid yet. So that's their floor. So if a company is sold, they're going to get their money back before the common stockholders or before the founders get their money. And that's the liquidation preference. They stand in preference to the common stock. It's found in every preferred stock deal. It's maybe the most critical piece of them holding preferred stock, is that they have set the minimum that they will get paid back first before any founders get paid. Now, what normally happens is the company does well, and if it does really well, you want to sell the company. Well, they don't get that liquidation preference anymore. The way that it works is they have the right to either receive the liquidation preference, or they can convert to common stock and be paid out like a common stockholder. And typically the way the document is drafted is they get to make that choice, and whichever one of those 2 scenarios would get them paid more money, they get to make that choice, and it either converts to common if that's going to get them more money, or it stays as preferred stock and they get their capital back if that's what's going to get them more money in either one of those scenarios. So it's very optional, and that's the way they're really all set up. I'm going to move through for just a couple of minutes, move through some of these quickly. I mentioned some of these before, but voting rights. So most of your equity investors are going to ask for a board seat, maybe multiple board seats. They're going to try to kind of drive a balance on the board of directors with the founders, so that the investors are represented well enough, and the founders, sometimes they even set up situations in which the founders kind of lose control, meaning you might have a 5-person board, 2 founding seats, 2 Series A seats, and then you appoint an independent director who's kind of your tiebreaker if everyone can't agree. That's a pretty common structure, but they're going to want voting rights no matter what. Protective provisions. This is what I called before negative rights, or approval or consent rights. So here's a laundry list of all of the things that you have to go to your Series A investors and get their approval for before you can actually engage in any of these types of transactions. These are in almost every deal as well. Anti-Delusion Provisions. This is a provision that says, I'm a Series A investor. I bought my shares at $1 a share. If you go out later and you sell additional stock, but you're selling it at 80 cents a share, well, my share price, my $1 share price, is going to get ratcheted down not completely down to 80 cents, but it's going to be weighted based on how many shares I bought at $1 versus how many shares you sold to somebody else at 80 cents. There's this formula here that has a weighting mechanism so that they can be basically made whole in what we call a down round. Redemption rights. Many of these Series A investors are looking for liquidity at some point. They're either going to want to sell the company, like I said, or force an IPO. They also often negotiate to have redemption rights where they can just say to the company, hey, you have to buy me out at a certain value so I can exit and return capital to my to my base of investors. This is heavily negotiated. It's kind of an interesting one. You know, if the company's doing well, no investor wants to be bought out, so they don't ever trigger it. If the company's not doing well, the company doesn't have the money to pay for the redemption anyway, and so it's a big so what. Some investors, because of that, don't even ask for it because they know that the likelihood of this provision ever being triggered is almost nil. But some investors really stand on principle and they want to preserve the optionality to have this for themselves. So you'll see that in some deals. I'll skip past the terms of the stock purchase agreement into some of the other documents. There's going to be in an equity round, certainly in a Series A round, there'll be a document called an investor rights agreement. This gives the investor the right to cause the company to go public. It gives the investor the right to sell its shares in the public markets at a later time. It gives sometimes it gives the investor some additional consent and approval rights and board rights. I'm going to scroll through quickly, and usually gives them a bunch of information rights. They can ask for books and records and monthly financial reports and statements. There will be a right of first refusal and co-sale agreement. That really locks up the founder's shares. That's the purpose of this document, is if the founder ever wants to transfer their shares, the investors can step in and buy them out. There will also be a voting agreement. So this is where everyone will agree to what the board composition looks like, and everyone will agree to vote their shares to make sure that board composition stays the way it is. There'll also be a drag along, usually provision that says that if a certain number of shareholders decide that they want to sell the company, they can actually drag all the other stockholders along in that sale. So that's a very common provision as well. So that was very quick at the end, but we're running just about out of time. So I think at this point, there is another question that's popped up. Why would an investor want to do a SAFE? That is an outstanding question. When I represent investors, I usually tell them you never, ever, ever want to do a SAFE. And largely it's because if, as a lawyer, I'm telling them, you're going to have a financial instrument, you're going to invest in this company, I want to make sure that you have the best possibility of getting what you bargained for. If you invest in a convertible note, I know I know whether it converts or doesn't convert, I know it's debt. And I know you can go to court and you can enforce your debt. And there are hundreds of years of case law that talk about how a creditor can enforce their debt and maybe probably get paid nothing, but maybe stand a chance to get paid something. If there's a SAFE, it's not debt. So we can't really give, and I don't think I'm not aware of hardly any case law litigating what a SAFE is, what if a SAFE is breached, what are investors entitled to, and so I can't give those same assurances to my investor clients about that. So as from an investor seat, you do a SAFE if you're really willing to just lose the investment, but you want to have a stake in the ground and you're willing to help a company at a very early stage. It's very inexpensive to do. It's very straightforward in that respect to do. And if you're willing to kind of take the flyer on it, then that's fine. And it's really a lot about your risk tolerance as an investor. Okay, let's see if there are other questions. I think that was it. Does anyone else have other questions? I don't know if I missed anything in the Q&A, but happy to answer them. I think people might be able to unmute themselves and chime in now or send more Q&As.
Thank you, Joe. Presently, there's no other questions. While we are waiting for questions, I'd like to introduce a poll with a few questions to get each and every one opinion. It would be really appreciated and valued so we can better be more proficient or helpful in this session. Thanks. While this poll is being introduced, you can raise your hand and we will unmute you and you will be able to ask your question, or you could type it in the Q&A.
So while we are waiting, Joe, I'm noticing that 100% of respondents answered the question, would you like a follow-on workshop on the same topic and with the same speaker? And 100% said yes. Then we can discuss.
Well, that's encouraging for me. That's great.
Yes.
I would welcome that. I'd be very happy to do that.
Yeah.
Yeah, and for this group, if there's if people have specific questions, we could even drill down. We could break it into more than one, but we could drill down into some more detailed items as well. I know we moved pretty fast over a lot of ground.
Yeah, it's a huge topic for discussion. So covering that in 1 hour is a lot.
Yep.
But thank you so much for doing this for us.
Oh, very, very happy to do it. Thanks for everyone for thanks for everyone for being online, and I'm happy to do it again or do a follow-up workshop. So I hope to speak with everybody again.
All right, at this time, I'd like to thank each and everyone for participating today. It was a great session, very informative. Thank you, Joe, for presenting. We really appreciate your knowledge and information. It meant a lot to me and I hope to others as well. And Ala, thanks for setting this up. I appreciate each and everyone being here, and thanks. Have a great day.
Thanks all. Take care.